Hello, everyone, and welcome to Limitless Success. This is episode 2, Navigating Successful Practice Transitions. And we have a very special guest on. We have Bill Barrett, who is the CEO of Mandelbaum Salzburg, which is a large legal firm that handles all of these things with a tremendous amount of expertise. So very excited to have you on, Bill, and let's dive right into this topic because a lot of people really want to know what's going on out there in the transition world.
Okay. Well, thanks, Fred. I appreciate the introduction, and just want to make sure I got the slides working here. Okay. Oh, there we go. So, Fred, I think a good place for us to start today is just a quick little overview on the state of the marketplace for practice transitions in terms of what we're seeing out there. And right now, the transition space, or what we like to refer to as M&As, it's very, very hot. I think that a lot of people have gotten wise to using mergers and acquisitions as a way to grow their practice and grow it much faster. People are looking to buy practices. There's consolidation taking place. And, you know, if you think about it, on average, the statistic, I think, is about 10,000 baby boomers a day are retiring. And, you know, you have practices coming onto the market, and there's an opportunity for consolidation. And I also think that, you know, in terms of multi-practice operators have realized that having working partners at the various practice levels, you know, junior partners, is also a very valuable strategy to put forth. So, you know, you put all this together and then you throw corporate dentistry into the mix and how they're heating up the market and the competition for practices, and it makes for a lot of activity.
Well, yeah, we're looking at a very different complexion to the marketplace just in the past 10 years. Wouldn't you say that? I mean, it's really a major shift.
Yeah, absolutely. And I think that, you know, we see now more activity than we ever have before. I mean, it's very active. And what's interesting is, you know, also when I look back over, I've been doing this for over 20 years. And when I look back over the type of activity that we had even like 10, 15 years ago versus now, not only is it much more active and there's a much higher volume of transactions, but it used to be, you know, maybe 1 out of every 15 deals I would touch had a private equity or corporate type dentistry component to it, you know, maybe an investor using a management company in conjunction with a doctor. And, you know, today it's more like 7 out of 10 deals that cross our desk have a component like that. So it's definitely, you know, a much different environment than it was, for sure.
Oh, and let's do our legal disclaimer here. We want to make sure people know that you're not dispensing paid legal advice here. You're identifying and analyzing the issues and situations, and they shouldn't do anything without talking to a licensed attorney about this. This is meant for informational purposes, folks. Very important to remember here as we proceed. But we've got a ton of information here, and Bill, I got the slides. So
yes, yeah. So we'll move forward to start. I think we'll start off talking about associate buy-ins, and you know, the structure today for our discussion will be we'll first talk a little bit. You know, when we use the word practice transitions, it means a lot of things, right? It's kind of a term that, you know, it's interesting. I do a lot of mergers and acquisitions in all different spaces in healthcare and other places. And dentistry is the only profession where the term practice transitions is used. It's kind of interesting that it's its own description unique to dentistry that just evolved as you know, part of our vocabulary. And we're going to start talking about associate buy-ins, and then we'll segue into kind of outright sales and purchases. And a lot of this, I think, is good educational nuts and bolts. You know, how do transactions work? What are the key big issues that you need to be thinking about? What are some of the contractual things to think about, the business implications? So let's start with associate buy-ins. And, you know, associate buy-ins are attractive in a number of cases, but, you know, from my perspective, you know, if you're a practice owner and you are at this stage where you're kind of looking ahead to the future of your career and succession planning, when you are able to bring on an associate into a partnership role, you also protect yourself from issues, death, disability, retirement, you know, any of those things that are potentially going to occur in, you know, in your future. If you have a partner, you have a plan. And that, I think that succession planning in general is a very positive thing. The other thing is, for our very entrepreneurial dentists who are looking to have multiple practices, one of the things you always hear is, you know, how do I attract talent? How do I keep talent? And for those doctors who really want to be owners, being able to offer a minority partnership creates some stickiness where, you know, they're now vested in the enterprise as a partner. And, you know, we use the term working partners. If you're going to own, you know, 3, 4, 5, 6, 10 practices, whatever it may be, it's going to be hard to have that many practices with just associates at every practice. But if you have partners at various practices who have a vested interest in the success of that enterprise and they're owners, you know, you're able to spread out the management responsibilities and to be able to grow your enterprise, because you can rely on those partners at the various levels. Otherwise, you're trying to manage 10 practices by yourself, and it's very difficult to do.
Yeah, so you're talking about, when you say associate, you mean somebody who's just brought in to work in the practice. They don't have any ownership. And so the opportunity is to take that dentist who's maybe recently out of school and doesn't have the money to buy a practice. This is a great way to turn them into an affordable ownership situation, right?
That's right. And we'll talk about how to stage that a little bit as we move forward, but that's exactly right. So when I use the term associate buy-in, you know, I'm talking about the junior doctor, right, the person who is the up and coming person who's descending to ownership. So let's segue to the next slide to talk a little bit about value.
What's my practice? The big question. What's my practice worth? Right.
Right. And you know, for the longest time, I could answer that question so easily. In fact, I can remember almost answering it a bit like cavalier, where I'd say, well, you know, you could go and pay some valuation expert a whole bunch of money for a fancy book that's 2 inches thick, but at the end of the day, it's going to be 75% of the average gross receipts of your practice for, you know, over the last 3 years. And that every time I read a report and then I just sit there with a piece of paper and do 75% of the gross, I end up within like 5% of the $10,000 report that somebody bought. And that's kind of the way it was for a long time. And, you know, what's happened now is, and this is just my personal opinion, a couple of things are happening. One is that with the emergence of DSOs and corporate dentistry, they analyze the value of a practice differently than traditional methods, and they're really looking at return on investment for them. Because remember, they're not looking to turn a handpiece here. They're running a business operation, and their approach is different. And a lot of times, their methodologies of valuation, depending on the multiples of earnings that they view a practice as being worth, can yield purchase price and or valuation in excess of 100% of annual gross. So, you plant that seed in the head of practice owners, and, their expectation of what their practice might be worth goes up dramatically. And there's so many factors that impact it, that it's kind of, their expectation is a little misguided in some respects. But I still do start from the point of looking at a practice and saying, okay, I'm going to take the weighted average of the gross of this practice over the last 3 years. And so maybe I'll take, for example, let's just say the practice does $1 million last year. You would take 3 times that, and it does X the next year. You take 2 times that, and it does, Y the year before that, and you take that number, divide by 6, and now you've got the average gross over the last 3 years, and then multiply it by 75%. I still do that as a starting point when someone starts asking me questions about value, because I do feel that in arm's length transactions and in kind of what I'll call one-off purchases and sales, it's still a pretty accurate calculation. But there's no question that the market has changed and the expectations have changed, in my opinion, in the upward angle. And, I also throw in there that the fact that specialty lenders will finance 100% of acquisitions also has an impact. And they will finance associate buy-ins. So we're going to talk in a little bit about structure and how that works. But, I think that right now prices are on the rise. So that's kind of the message that I'd like to put out there.
Yeah, well, I remember, I think it was earlier this year, I heard one of the CEOs of a big DSO say, look, we're still paying 0.8 times annual collections. So there's this illusion that's sort of been spread that, oh, I could get 2-3 times my annual gross selling my practice now to a DSO. That's not really happening. It's moving up from your 0.75, your 75% number, but it's not doubling or tripling. That happens when you create a DSO, more likely, right?
Well, there you go. So when you've built out your own DSO, or you're a multi-practice operator where you're aggregating your earnings among multiple practices, it drives up, there's economies of scale of running a larger operation, and it drives up earnings, and therefore by pushing earnings up, it raises the multiple. You're still not going to see, 3 times the gross receipts. I mean, even in those instances, but you will see prices exceed 100% of annual gross. But when you're a single practice, and this is your point is spot on, a lot of the purchasers, even the DSO purchasers who are trying to roll this up into their enterprise, they might be somewhere between that 0.8 and maybe 1 times, but I'm not really seeing more than that. So, so let's talk a little bit now and move to the percentage offered on a buy-in. And again, this is just my view or my opinion, and I'll give it from both sides. Obviously, if I'm the junior doctor or the associate who's buying into the practice, I'd like to buy as much as I possibly can. That would be my goal. If I'm representing the senior doctor, I really want to take it slow. And frankly, because the market right now is excellent, and because pricing is moving upward, you don't want to necessarily sell off in a transaction with your associate a large piece of your practice. I'm not a fan of 50-50 partnerships. Throughout my career, I can't tell you how many times we've dealt with breakups and deadlocks and problems between partners when it's 50-50. I think that there always, for lack of a better word, there needs to be a king or queen among equals. And I think that having centralized leadership and a person who is the majority is a healthy thing.
Yeah, well, and that applies to really the whole business world. If you've got two partners, what do you do when you disagree? Where's the tiebreaker? Who's the decider and who's responsible? What happens a lot of times is you do that decision and one guy was pushing for it and he gets the blame for it, even though it's a 50-50 arrangement. So, but as you say, a lot of it, somebody's got to be the final decision maker. Somebody's got to be the king or queen in virtually any business. And for an associate to come in, they've got to respect minority ownership is all that's coming their way, and that they've got to grow the value of the whole business so that their minority ownership is worth something more.
That's right. And I, from the senior doctor standpoint, you want to see how they respond to being an owner. Before you start selling off large pieces, you want to make sure that this works. It's much easier to unwind a minority partnership than it is when someone gets up to owning, 40 or 45%. I'm a fan of maybe 10 to 30% being the range, with kind of 20 or 25% being a comfortable number. And it's interesting, you mentioned growing the value of the business. One of the things that I'll mention here, and I'll probably mention it somewhere else too, is there's always this age-old debate on valuation in terms of associate buy-in, the younger doctor in the future not wanting to pay for the increased value, because they'll say, well, I am part of the reason why this practice is now worth more money. And when we have a secondary buy-in or an event that occurs that requires a buy-in or retirement or whatever the case may be, they're like, they want to go back to the valuation when they bought their first 10 or 20%. And the senior doctor will say, well, wait a minute, don't I get credit for the practice that I started? And I'm the one who took the entrepreneurial risk to hire you in the first place and then to offer you partnership. And now you don't think I deserve even a portion of the upside or the growth of the practice? That's like an age-old debate that will probably last for as long as I practice and long beyond that, where it's kind of like, each side feels like they deserve the pie, and they don't understand why the other side thinks it should be a smaller slice. So
yeah, I can see that happening very easily, and that's why you need a third party to give you perspective on it too. Somebody who's out in the world doing these transactions like you, that says, by the way, this is the standard and this is how you should be looking at it. Because otherwise it's just an emotional, I did all the work, or I built this, why should I pay more for it? But the associate he's joined the rocket ship to Mars after it's already escaped gravity, and so you don't get all the real estate of Mars for it. So without paying a little more.
That's a great way to say. And what usually ends up happening, at some point, Solomon's wisdom prevails, and there's a compromise where the senior doctor gets to enjoy some of that upside, but maybe the junior doctor doesn't pay for all of it, and that's kind of where it usually ends up. All right, so let's move along to the next piece here. And
talking about collateral and the lack of it.
Yeah, deal structures. So the thing about the next couple of slides that we'll go over together are going to talk about different ways to structure these types of deals for associate buy-ins, and we're going to talk about several different ways to do it. The first being a cash purchase at closing. So I'm the senior doctor. I want to sell you 20%, and I want all the cash at closing. And let's assume for the moment the junior doctor doesn't have, it's a $2 million practice. 20% is going to be $400,000 cash, and I, as the junior doctor, don't have the $400,000. So senior doc says, well, go get a loan. There's all these great specialty lenders out there. and they'll be happy to give you the 400,000. And the senior doctor is right. They are happy to lend you the 400,000. Where it gets a little tricky, and where I say here lack of collateral creates challenges, is that the bank is not just going to give 400,000 on the signature of the junior doctor, who typically will not have much in the way of assets or credit or savings. So what they'll say is, okay, we'd like the practice to provide a corporate guarantee, and we like to file a UCC to, in essence, securitize our guarantee. But so a lot of times the senior doctor will say, well, wait a minute, I'm kind of guaranteeing my own deal, but that's kind of the price of admission. If you want the lump sum and all the cash in your hand at the time of the closing, you are, in almost every case, if there's a lending institution involved, going to provide a corporate guarantee from the practice. And I don't personally, as a business person, I don't get worked up about that, and I try to get my senior doctors who are getting worked up to chill out a little, because I'll say, look, are you confident that the practice throws off will throw off the income to pay for this? I mean, it's a simple pro forma. Will the junior doctor be earning enough now that they also get a portion of the profits to satisfy the monthly obligation to the bank? And if the answer is yes, senior doc knows their practice better than anybody, and they just have to get comfortable. But as they so and there is the opportunity to get lump sum at closing. Moving to the next type of deal structure, an installment sale. This is the traditional, call it the old school way. When I first started practicing law, the specialty lenders had not started throwing money at young doctors for associate buy-ins. Forget about purchases and sales, but they were not at this place yet where they were like, sure, we'll give you $500,000 for an associate buy-in. So it was always the senior doctor, as we like to say, holding paper, holding a promissory note, and the junior doctor paying it off over time with a interest rate, and putting a down payment down, maybe 10 or 20% that they saved up as a down payment, and then over a period of years, they would pay off their obligation to the senior doctor, and they would pledge their interests to the senior doctor. So if they defaulted and didn't make the payment, senior doctor takes back the interest, keeps their money that they paid so far, and that's kind of the story. Today, we see a lot less. I mean, we always get these deals in, but you see less and less people holding paper because the banks are willing to lend. Where it does pop up is sometimes, especially when you have a senior doctor who's very stable financially, from a tax standpoint, they may say, you know what, I think I prefer to act as the bank and take this payment over the next 10 years because I don't want to realize the entire gain in one tax year. So if I get, the hypothetical $500,000 in a lump sum, I pay all the taxes on it in that year. Whereas if I pretend I'm the bank and I let them pay me with a note in an installment sale over time, it's spread out, and I'm realizing little pieces of the gain over the term of the note. So that's kind of the deal there.
Now, does that typically carry interest as when the doctor does that?
Absolutely. So they earn interest income, and sometimes they'll say, in a conservative investment, maybe I'm only going, to earn a small interest rate, and so they'll say, hey, I can get in an arm's length transaction, the percentage I can get is going to be even better. So, it just depends on their situation. So, moving along to sweat equity. The sweat equity is a term that's kind of loosely thrown around, I find. But at the end of the day, what sweat equity really is saying, okay, in exchange for your efforts, basically. So instead of giving you all green cash or income for performance over a period of years, as additional consideration for your performance, I'm going to, in essence, give you interests in the company. So long as you and a lot of times these deals look like, so long as you hit minimum thresholds of productivity, and, there might be benchmarks that you have to hit. And if you hit all the benchmarks in a particular year, you might get X percent. The problem with that in sweat equity is the way that the tax law works is if I give you something of value, if I give you a piece of value, even if it's not cash, it is taxable when I give it to you.
You mean the associate,
correct,
the junior dentist buying in, right?
Correct.
Yeah,
so
he's been essentially paid something of value. It's like he's been given stock essentially.
Correct. And why we call it phantom income is that he's been handed a stock certificate, and let's say it's worth $100,000. He may owe $30,000 or $35,000 to the government because of the value he received, but he didn't actually get any dollars. And for these younger doctors, sometimes they don't have $35,000 or $40,000 or more burning a hole in their pocket to pay Uncle Sam the taxes. So, it creates this phantom income problem for them. And that's why when you do sweat equity the right way, which is, the doctor actually, the senior doctor takes a deduction and then it's income to the junior doctor, a lot of times that causes a problem. So sweat equity is not, we don't do much of that these days anymore. So let's move to the next one. This is an income differential. Again, another technique that's been deployed out there. And this is basically to say, okay, I'm going to take a larger salary than you for a period of time. I'm going to, in essence, gift you interest in this business, but for a period of time, I'm going to take a lot more money than you. So my salary, might be, 3 or 4 times what yours is, but you're not going to come out of pocket at all, and you're going to ascend to interest in the business. The problem with that is, and again, we do it here and there when people request it and they want to do it, but generally we frown upon it because you're paying full income tax on the income differential on that higher income you're taking. Whereas had you done a traditional sale and actually sold the interest in the business, you would have paid capital gains on it. So you're paying a higher.
Yeah, so that's the owner doctor. Now he's created a tax implication for himself.
Correct. By saying, oh, okay, this is the way we'll do it. I'm just going to gift you these interests, but I'm going to take more money out of the company than you, but you're taking it out as income. So you're paying more tax, whereas had the person gone and gotten a loan and paid you the $400,000 or $500,000, whatever the purchase price was, you would have realized capital gains on it, not income tax. So it's not efficient from a tax standpoint. The next one is one that shout out to Fortune and the creativity that so often comes from Fortune management. And I didn't really ever deploy this structure or use it, and frankly, until I met Bernie, and I kind of fell in love with this structure, which is the idea of a shadow account. So what I like about this is a shadow account, in essence, is it's really an accounting, if you will. There's no money actually changing hands, and you come up with some kind of formula, whether it's based on production or some agreed upon mechanism by which you say, okay, based on what's collected on your work effort over a period of time, I'm going to allocate a certain percentage of that. And we're going to kind of keep track of that number, that dollar amount. And ultimately, when you buy in, that's going to result in a discount. So when you go to buy in, we'll value the practice, and we'll determine how much you're going to buy in, and then we'll look at your shadow account. We'll see how much of a discount you've earned, and that will result in you getting, you know, a buy-in at a lower price. And you know, I've looked at this structure quite a bit because I found it intriguing. And you know, as a lawyer, first thing you want to do is try to punch holes in something, and because the laws, and you know, not to get overly complicated, but because the tax laws allow discounting for what we call for a minority interest, first of all, because it's not it's a small interest, and lack of control is a minority interest. It's a discount that's permitted, and lack of marketability, meaning there is no market for, you know, you can't go to a stock exchange for a minority interest in a dental practice. So the IRS code actually has the concepts of lack of marketability and lack of control as things that are permissible discount mechanisms when dealing in transferring ownership of assets. So the shadow account really works because the way you're in essence creating stickiness, you're giving the associate something to shoot for. They're working hard. They're creating a column, if you will, or a ledger that is going to provide for discounts. And then 5 years or so later, when they have the chance to buy in for their 20%, they're going to buy in at a lower price. So it's almost like they've paid in to it already during that process. So I really like the shadow account. I think it's very creative.
Yeah, it uses their production to gain a discount, and then you're just making a calculation up to that date. Nobody's paying any taxes till there's an actual transaction, and if there's an actual transaction. So yeah, because the worst thing about the other deals is you can be paying taxes on something you never complete, or that goes down in value. This is a beautiful structure. Definitely, you know, I was going to ask you what the best solution is, but I think we're kind of looking at it. So
yeah, I mean, this definitely serves its place. I mean, if somebody's looking for you know, an immediate close and an immediate transaction, one of the other methodologies might be better. But when someone wants to you know, have an associate earn their stripes, if you will, over a period of time and build up to a purchase and reward them, this is a great structure. So moving on to the due diligence slide here, which I think is very important. You know, when doing these deals, you have to, when you're the person buying in, you have to do your diligence because, you know, maybe you've been an associate in the practice, but you're not really intimately familiar with all the finances and kind of the behind the scenes of the practice. You know, it's very rare that a senior doctor has allowed access to that. So, you know, you have to assemble a team. Obviously, everyone should always have, you know, their accountant, their attorney, their practice management coach working with them as they go through the diligence process. And, you know, that includes looking at what liabilities the practice might have, because once you buy in and you become an owner in that practice, they become your liabilities. So you got to make sure that you understand what the liabilities are. Conduct searches not only on the practice but on the doctor to see what kind of liens there might be out there, to make sure that you're not about to get into bed with a partner who is got tax liens or financial problems that you were not aware of. And you know, I've seen stories over the years where, you know, the junior doctor was going to be the life raft for a senior doctor who was actually in quite a bit of trouble. And, you know, you flush that out through the search process. And considering the existing obligations of the practice. And then you got to look at things like, okay, is the junior doctor prepared to provide personal guarantees of some of the practice's obligations? A lot of times the practice might have bank loans or debt, equipment loans or debt. The lease for the practice might be personally guaranteed to the landlord, and those third parties are going to expect the new partner to join in in the guarantees. In fact, a lot of times the provisions inside those documents call for, if there's any change of control in the ownership of the practice, that they have to get it approved first by the creditor. So that's something to look at. And then verifying financial data. The good news about someone who's been an associate in a practice before buy-in is that while they might not know any of this stuff and they have to diligence these types of things, they do know the personality of the party they're dealing with. They do know the quality of the dentistry. They do know the staff and whether or not they culturally have a fit and bond with the staff that's going to work out long term. So there's a lot of advantages to having been there for a while before a buy-in, but usually these are the types of things that even if you've been there a while, you might not really know, and you have to do your diligence and get comfortable.
But this is also the beauty of the shadow account approach, which is you're not actually taking ownership. So a lot, the liabilities won't fall on you. They'll fall on the practice, certainly, and you don't want to be, you'll still want to know about them, but you're not, until you actually acquire ownership, you're not dragged into this. And also the bank is also not dragging you into some of the obligations. So it's just one more benefit to approaching it with a shadow account, I think.
Yeah, I mean, really, when you're an associate, whether it's a shadow account or any other scenario, while you're an associate, you don't have any obligations or liabilities for any of these things. But in any case, whether or not it's a shadow account, once it's time to buy in and it's time to consummate the deal to become a partner and no longer just an associate, you have to do your due diligence, regardless of the deal structure.
Yeah, so, you got to know this stuff, and a lot of people, they go in blind and they find out something's looming, an employee litigation or something like that is sneaking up on them, and now they're in it too. So,
yep. All right, so moving along, now we're going to segue from kind of essential steps and things to consider to talking about the critical documents in an associate buy-in or call it a partnership type deal. So the first document that you need to know about is the purchase and sale agreement. And you'll see on the slide, it says asset purchase versus an interest purchase. A lot of times when you're buying into a practice, you're buying an interest in the existing business entity. So if it's a corporation, you're buying stock from the seller, from the senior doctor, and you're becoming an owner in the existing business entity. And sometimes there are structures set up where a new company is formed and there's a sale of the assets, and the new company makes that acquisition. And there are tax reasons and things that drive the structure that you're going to go with. But in either case, you're going to have this purchase and sale agreement. I'll just use that as an overall term. And this is where the key points of the deal are going to be memorialized. What's the purchase price and what's the terms of the purchase? The structures we've been talking about would be reflected in the purchase agreement. The representations of the seller. What representations are kind of call it the promises or the statements that the seller is making to the buyer, saying, look, I represent to you that these things are true. Stuff like, I represent to you that there's no lawsuits pending against me or threatened against me. I represent to you that I've followed all of the employment laws as it relates to my personnel. I represent to you that I've filed all of my tax returns in the ordinary course, and I've paid all of my taxes, and that I have no outstanding obligations to the IRS or the state government, and so on and so on. These are all the promises made. And when those promises turn out to be false post-closing, that's when you've heard the term, somebody breached their representations. They lied, in essence, about whether something was true or not, and it's now had a material effect. But when you are a buyer and you make the seller represent all these various things and something turns out not to be true, this gives you recourse in the event that the deal goes south. So it's a very important section of the agreement. And the next most important thing is what we call the indemnification. The indemnification, put simply, is just the clause in the agreement that says, hey, look, if anything rears its ugly head that relates to before you became an owner, so if I'm the seller, something pops up that relates back to before you became an owner, I indemnify you. I hold you harmless. I protect you from those liabilities. So, for example, let's say I'm a junior partner, I bought in, and the practice gets audited for a tax problem from 2 years before I became an owner. That's when the senior doctor would have to indemnify and say, hey, that's on me. That predates your ownership. My responsibility, not yours. That's what indemnification means. And then contingencies, which would also be included in a purchase and sale agreement, those are for things that have to be accomplished before the transaction can be binding. So, for example, if the associate is getting financing, there might be a financing contingency to the contract or a due diligence contingency. So the associate has the time to hire their professionals and do the appropriate due diligence on the practice before they close. These are the conditions precedent, if you will, that have to have occurred in order for you to be obligated to move forward. So those are some of the key points of the purchase and sale agreement. And the next important agreement is what we'll call, in quotes, the partnership agreement. Now, whether or not it's a partnership agreement, an LLC operating agreement, or a corporate shareholders agreement depends on the type of entity. So a partnership is a partnership agreement. An LLC, we call it an operating agreement. A corporation, we call it a shareholders agreement. But what it effectively is the governing document between the partners after this deal is closed. How is decision making made? Is it all by majority, or are there some things that are require unanimous consent in order to happen, like a sale of the practice or relocating the practice or borrowing money or something so big or important that they should be unanimously agreed to. So that's the decision making and governance has to be built into this agreement. And then what we call the buy-sell provisions. This is what happens if someone dies, becomes disabled, wants to retire. What are the obligations of the parties when that occurs? Or what if somebody wants to withdraw early? So we have two partners and someone says, hey, I'm out. How's that going to work? That's where you build that into the buy-sell provisions. And then a very critical clause in a partnership agreement is the valuation formula or clause for a buy-sell event. So if someone does die, become disabled, retire, or wrongfully withdraw early, how do you value that at the time that it occurs? What's the interest going to be worth? And does the other party have to purchase the departing party's interest? For a lot of times, for a wrongful withdrawal, we'll actually make a discount. We'll say, okay, here's the valuation formula for an event under the buy-sell sections of the agreement. But if you wrongfully withdraw, whatever that number calculates to, it's discounted by 25% as a penalty for not leaving in the what I'll call the traditional way and for leaving in a wrongful way.
So somebody could, there'll be a very specific formula that says the value of the business is 100% of the average of 3 years collections at any sort of buy-sell moment, but there's a 25% discount. So these are hard number calculations that can be applied, just like you say, that formula of acquisition. How's that calculated? This is going to spell it out. And then there's these contingencies that affect that number.
Yep.
that people have already agreed to. So, because what you don't want is to be debating and disputing. You know, you tie a dental practice up in 2 years of litigation, there's no dental practice anymore at that point. There's nothing to buy or claim. So this has got to be, it's got to be contemplated ahead of time.
Yep. And you know, we've seen those horror stories. I mean, you know, we sometimes get the phone call where someone has the problem already, and now we sit down and read some horrendous partnership agreement that was written, and you know, the attorney didn't put in valuation concepts, didn't really flush out what would happen in various situations, and now you have a real problem on your hands, and people end up in litigation, which is a nightmare.
Yeah, now the junior dentist finds out that the dentist's spouse is his new partner, or something like that. You know?
Yeah, something to that effect. So restrictive covenants is another important, which is basically to say, hey, look, you know, if one of us leaves the practice and the other person retains the practice, there's got to be some type of restriction on, you know, on how you practice and where you practice, and how or if you solicit from the existing practice, whether it be patients or employees. So you always have to consider a restrictive covenant. And then a dispute resolution. I'm a believer in trying to really craft a very precise dispute resolution formula inside the partnership agreement. A lot of times what I do is I write a provision that says, okay, if we have a dispute and we can't resolve it ourselves, we're going to agree to a binding arbitration in front of one sole arbitrator who will be a retired judge, and we both agree to split their fee equally. And at the end of the arbitration, the non-prevailing party, the person who loses, pays all the expenses. And that way you hope to create people's cooperation towards resolution, because they don't want to get stuck with the bill afterward. But also, if they can agree, you have an expeditious resolution, you know, by one party whose fees are split by the parties, and you know, you get things resolved that way. So those are some of the key provisions that you'd want in the partnership agreement. And then the next agreement is the employment agreement. A lot of people say, well, wait a minute. Okay, I get the purchase agreement and I get the partnership agreement, but you know, if we're owners, why do we have to have an employment agreement? And it's actually a very key and critical document, because you wear different hats when you are in business. You know, you wear the hat of an owner, but you are also an employee of the enterprise, and you have to figure out, how are we paying ourselves? You know, are we getting paid a percent of our production? Are we going to have base salaries? You know, what are we going to tie into how we get paid? You know, you want to have that all cleared up in advance, so there's no issues. And also, you know, what if some bad things happen? What if someone gets pulled before the state board and is sanctioned, or loses a license, or is convicted of a felony? You know, there might be reasons why a partner would be terminated and then tied into their partnership agreement, perhaps forced to sell their interest to the other party. So if one partner, you know, is convicted of a felony, they would immediately stop working for the practice, and then they would be bought out by the remaining partner. And that would be one of those things that would be subject to a discount, like I described before. So that's why you have to have that. And
also, sometimes with those things, it's like if it's triggered like unexpectedly, a lot of times you don't just set up a discount, you set up payment terms, so that somebody doesn't just have to write a check. They may have 2 or 3 years to pay this off, right? That's also something you disclose, because somebody's not necessarily going to be able to come up with the money, and they don't want a surprise, you know, bill that they got of some enormity that they've got to pay. So many times you're going to write into it that if this happens unexpectedly, I've got 2 years to pay, you know. So
that's right, and that's all built in. And then you have to look at things like schedule and time off. I had a situation occur where a guy came to me, and he's the big producer in the practice. He's also acting as the CEO dentist. They've got like 6 locations, and his partner is they're 50-50 partners. Their agreement is, unfortunately creates deadlock everywhere. It wasn't a great agreement. And the one partner who's not really pulling his weight, he's a 50% owner, and their practice is so profitable that even after they pay themselves in accordance with their comp formula, so each guy gets 35% of collection, and the one guy is a massive producer, and that's fine. But the other guy decided, I'm going to work 1 day a week because I actually don't care, because my 50% profit is $1 million, and I'm happy to work 1 day a week and collect my profits. And the other partner, who's killing himself and he's running the practice, he's getting no additional consideration. So he's like, okay, wait a minute. I'm working every day of the week and I'm making like, $1.6 million, okay? And I'm literally like 6 days a week. I'm the CEO. I'm killing myself with production. He's working like a day a week and making $1 million. And his production is almost nothing, and he does no management. That's a problem because they didn't flush out the employment aspect of the partnership. They didn't talk about, if somebody acts as the CEO, what kind of compensation do they deserve for taking on that extra management responsibility. And because they're 50-50, they're deadlocked. So it's a perfect example of why the employment agreement is so important. So, all right, well, that takes us through the concepts of the associate buy-ins and partnerships in terms of transitions, and segues over to outright sales and purchases. So this is not where we've got partners or buy-ins. This is where we're either buying a practice or selling a practice outright. And this kind of goes to the heart of our M&A discussion and kind of the growth of practices through mergers and acquisitions, and a lot of our entrepreneurial dentists that we work with, are out trying to grow their enterprise, trying to merge practices into their mothership location. And so I like this first slide. I like to talk a little bit briefly just about finding a practice. And I know a lot of the coaches out there are helping their clients find practices. And, these are the ways that I think are very effective to try to find practices. The cold introduction is really what I'll call the letter writing campaign. And, you're reaching out to doctors who you may not know, but you're basically figuring out, okay, what practices exist within a close enough geography that I would be able to potentially retain at least 75% or more of the patients that would come to my location, and reach out and try to, see if you can get some interest. A warm introduction would go to those doctors, in your community where them. Maybe it's a friend, maybe it's a friendly competitor, or just someone who you happen to know, but where you can call up, for example, and say, hey, have you done any thinking about your transition or your exit strategy? And I have some ideas about how we could do something better together rather than apart. Maybe we can have a cup of coffee or go out to lunch or whatever the case may be, and try to go with the warm introduction to create an opportunity. And then lastly, you have the third parties, practice brokers, lawyers, accountants who specialize in representing dentists, talking to people that are that are financial advisors, talking to staff members that might be at other offices. There's a lot of third parties out there who might know of someone who's getting ready for a transition and be able to give you the first piece of information on it. So now let's pop into, and I want to kind of briefly go through deal structures as they relate to outright purchases and sales. Just like in associate buy-ins, in outright purchases, there is a lot of money on the street available through specialty lenders. Just about every deal that you can think of is financeable. And, you know, payment in full at the closing, which, you know, cash today is always better than cash tomorrow. Okay, so let's
next. Installment purchase works very similar to the installment purchase that we talked about with associate buy-ins, where we've got you know, the seller acting bank and holding the paper, and you know, again, this we see even less so in outright purchases these days because the financing is so readily available. But again, for tax purposes, it's still an option. Next one, in terms of a structure, is I call it a hybrid concept. So this is where, and I just had a deal like this literally today that I got a phone call on. This is where the bank is willing to finance. They like the deal enough that they're willing to finance, but they're not willing to finance their typical 100%. They say, you know, we're comfortable with this deal, and we think that the will be okay, but we only want to finance 80% of the deal. But they'll allow a note by the seller for the other 20%, so long as it's totally subordinate to us, the primary lender. And what does subordinate mean? It just means it's a junior note. So the bank is secure because they'll say, if in the event the buyer is having financial troubles, maybe not meeting the covenants in our loan documents, we have a right to shut off the payments on the second note to the seller and kind of turn off the switch. They have an agreement, they call it an intercreditor agreement, with the seller who's holding that small note, where they can basically say, oh, we believe our borrower slash buyer is in some financial stress, and we're telling them to pay you anymore. That can happen, and that is the bank's way of protecting itself, but it's also a way of them saying, well, we like this deal, and we like it enough to do it, but we don't like it enough to lend 100%. That's another concept.
Yeah, and so the dentist is carrying some paper on it, and just because the buyer can't get the full amount, so
that's correct.
Not a bad situation most of the time. It's fairly reasonable to do. So
yeah, and it's not unusual. It just comes up in a deal where the bank is not insecure about the deal, but they're not jazzed up enough about it to lend their typical 100%. They want, and I've also seen this in scenarios where they think the transition is going to require a little more effort, and they want the seller to have some skin in the game. So the bank will, like for example, I'll see this more often in specialty practice deals where you've got to worry about the transition a little bit more. So in any event, you know, that has skin in the game for the owner. So all right, so last one I want to talk about is the earnout structure. Again, tipping my hat to Fortune and Bernie and Mark, the earnout strategy. You know, being an M&A lawyer my whole career, even dating back to before I did any healthcare transactions in traditional business, earnout concepts have been around forever. Concept, really simply put, is you get paid more money based on future performance. So if the business performs well and meets certain criteria post-closing, you'll get additional purchase price money, or you'll get paid over time, and that's the traditional concept of an earnout. Been around forever in regular traditional business strategies. Not been around much in healthcare or in dentistry, and we started deploying this strategy and for the right buyer and seller, it works very, very well. Typically, you know, the seller is paid a percentage of their gross receipts over a period of time, you know, negotiated between the parties. And sometimes there's a floor or a minimum that they'll receive. Sometimes there's a ceiling to it. There's a lot of different creative ways that you can attack it. But at the end of the day, what's nice about it is the buyer is not putting any debt on their balance sheet because they're not actually going and borrowing money. And the seller has the opportunity, if this buyer is going to invest in the practice and really, you know, start marketing more aggressively and try to build this business and build up the patient base, they can often enjoy the upside of a growing practice in the latter part of their career. So it's been a very successful strategy for a lot of people. It's not for everybody. There are some sellers who are like, hey, you know, I want my money and this isn't for me. But for the right parties who kind of see the bigger picture and are comfortable, it can be a very good strategy.
Yeah,
right, so
I mean, it seems ideal for a lot of situations. So
absolutely. Okay, so next thing I'll just touch on briefly, and you know, it may be stating the obvious, but sellers need to be prepared for the scrutiny that they're going to receive by third parties. A lot of times, you know, when people own their own privately held business, you know, they kind of treat the business like their personal checkbook, and all of a sudden now someone's CPA is going to rip your books apart, a banker, DSOs, forget it, because they're coming into your practice and they are hiring, you know, large national or sometimes worldwide accounting firms. You know, the Deloitte Touches of the world, they're coming in and they're going through your practice with a fine-tooth comb and doing the quality of earnings study. And, you know, when they're done, they know what your DNA is. So what I always tell my sellers is, if you're starting to think about a transition, start preparing for that a couple of years out in advance. You know, pay Uncle Sam some more taxes, make sure your books are clean, be prepared for the fact that somebody is going to scrutinize you heavily, and make sure that you feel comfortable turning your books over and letting people take a look, and that you've got all the data and the documentation to back up your position. So moving right along. Okay. I'll try to move through some of these, Fred, with a little more speed, because I know that we're trying to be respectful of how long the presentation goes. So the real estate piece. What I want to mention here is when you're buying a practice, the real estate component is critical. At the risk of stating the obvious, for some reason, if I were to have to give a top 3 list of things that blow up deals, it's often problems with a landlord or a seller in the real estate piece. More complicated sometimes than the practice itself. So understanding whether or not you're going to be able to get an assignment of the existing lease, or you're going to need to negotiate a new lease, and kind of flushing those issues out in advance is important. I'm a big believer too that if you have a chance to buy the real estate, it's another asset in your portfolio, and controlling the real estate where your practice is located is a positive thing. You know, that's just my perspective. All right, so let's move on to restrictive covenants. And I just want to briefly mention here the difference. The point I want to make in a sale or purchase transaction is the difference between employment restrictive covenants and sale restrictive covenants. The courts recognize that when someone sells a business, they are getting a substantial amount of consideration, and a big part of that is for the transfer of goodwill. So courts recognize that much broader, stronger restrictive covenants are appropriate in a sale transaction. So typically, when I write up a deal, it's got a 5-year non-compete in a sale of a business, sale of a practice, with a radius of, that's much larger. I know that in some states like California, for an employee, I can't have a non-compete, but I can have it in the context of a sale of a business, and it could frankly be relatively broad because the courts recognize your right to protect yourself in the event of a sale. So that's the point I wanted to make there. On accounts receivable, which is our next slide. Now, accounts receivable are typically and traditionally, they are the property of the seller. So these are, for work and production that has already occurred and been billed, but not yet collected. And typically, there are mechanisms put in place post-closing to collect that money. Sometimes the buyer will collect it and then turn it over to the seller as they collect it. I do like to recommend sometimes that my buyers negotiate a discount on the accounts receivable and buy it as part of the closing. Reason being that they're financing the accounts receivable in their loan, so they're effectively paying for that over, let's say, a 10-year period. But as the money rolls in, it's their money, and it's very helpful for their cash flow. So I like them to buy it, although a lot of times it doesn't work out that way, but it's something to look at. And the other thing that's really important here, and I always tell this story, is understanding when you set up a clause for collecting accounts receivable after the closing and turning it over to the seller, the difference between first in, first out, and last in, first out, FIFO versus LIFO, right? Just general accounting terms, but very important. The issue is if it's first in, first out, you have to be very careful that there are not a large amount of accounts receivable, and that they're not, and if there is a large amount of accounts receivable, that they're not spread out over a lot of patients or third parties, because the risk is with first in, first out, patient comes in for treatment. Let's say they come in, they need $1,500 worth of treatment. When they get to the counter to pay, they write a $1,500 check, but they had a $1,500 balance dating back to the prior owner. First in, first out, the whole $1,500 goes to the seller, the prior owner. So you as buyer just performed the services, used your staff, used your equipment, incurred the full expense of that treatment that day and got $0 because first in, first out required all the money to go to the oldest receivable first. So that's something really important. We actually saw a woman once who bought a practice go bankrupt because she had agreed, her lawyer did not advise her, and she had agreed to first in, first out. The problem was the seller had about $435,000 of accounts receivable spread out over like almost 1,000 patients. So people were coming in, and she was performing services and getting no cash flow whatsoever, and it just snowballed into a blow up. So gotta watch out.
And the indicator is that he's carrying a big account. He's letting everybody not pay him. So what you're getting set up because the patient is expecting, oh, I don't have to pay for treatment now. I just pay for my last treatment. So the large accounts receivable is the biggest indicator that he's essentially financing his patients, and you're going to get creamed if you do first in, first out.
Yep, that's exactly right. And it should have been a giant flare going off when they found out, saw 435,000 of AR spread out over that many patients. Culturally, it was a bad buy. So, all right. So moving along on due diligence on acquisitions, similar but different from when you're doing an associate buy-in. You're coming into this often cold. You've got to really rip through it. you want to have your team behind you in terms of your accountant, your lawyer, your practice management coach, your insurance professional, and you're looking and for things like whether or not there's any pending or threatened litigation. How are the contracts? Are there associates? Are they bound by good contracts, or could they hurt you post closing? I had a deal once where a client came to me after they had done a closing, and there was an associate in the practice who didn't even have a contract or restrictive covenant. Neither they nor their attorney thought much of it. The associate had already been building out a practice literally across the street, and post closing, they lost like half the patients because within like a month of the closing, the associate opened up their own practice literally across the street, and they had no restrictions, no agreement whatsoever. That should have been flushed out during due diligence. The other thing that I think is huge, and you got to be really careful, is whenever you're doing a deal with a multi-practice seller. So a seller who has several practices, you really have to dive in and be careful, because you got to be sure that the books and records are not commingled, that that revenue or expenses is not, expenses are not being put on another practice to make this practice look more profitable, or revenue isn't being pumped into this practice to make it look like it has a better top line. You want to verify any patients who've been treated at other offices and schedule them right on the contract, so that it's eyes wide open that some of these people have already treated at the other locations, because you may have to apply a discount for possible loss of patient volume if they decide to continue to go to one of those other locations and not go to you after the closing. Which is why I like to beef up the restrictive covenant a lot in a multi-practice seller deal. I like to actually schedule the patients that are allegedly the patients of this practice, and in the restrictions say that you will not treat or you will not perform services for those parties attached here to as such and such schedule. So you're literally putting their names right there and saying you are not allowed to treat these people, even if they find you and seek you out. Which is permissible in most states. A lot of people say, "Oh, well, you can't do that. It's abandonment." It's not true. Most dental boards don't buy into the concept of abandonment in a case of a transaction like that. And you give names of practitioners that they could go to, but it's a way of really beefing up your restriction. The reason I also have
the patient isn't being abandoned. There's a dentist who's going to treat them. So
that's right.
So I can see that standing
that's
up.
Right. Yeah, and it does. In most states, it's totally permissible. The employee census I put on there, and I'll just make that my one last mention as I roll to the next slide. I put employee census on there is something to study, because a lot of times when you buy a practice, especially a mature practice, sometimes the employees have been there a long time, and they've been getting raises every step along the way, and you kind of realize all of a sudden, hey, wait a minute, the hygienist, the front desk, whoever it is, they're not only at the top of the pay scale for what their job is, but they're 20% above the pay scale, and you're now inheriting that payroll and these people that have been there a long time who might be overpaid, and there might be a lot of profits flying out the door just because their salary has increased at a rate that goes far beyond the market. So that's something to look for. Okay. So options for work in progress. Dentistry is a little different than some other types of businesses in the sense that there's always going to be patients who are at some part of or at some stage of treatment. If they're receiving treatment for something that's like a multi-visit service, you've got to figure out what's in progress, who's going to finish it, and then what are the economics of that. So is the seller going to be staying on board for a while, and they're just going to take care of it, and maybe make a contribution towards the overhead, but they're going to keep the fee and get the work done, or are they going to require the buyer to complete the work and somehow share the fee proportionately? But you always have to look at work in progress and figure out, okay, what's the split of the fee going to be and who's going to get the work done. And then the next slide deals with corrective treatment. So again, this comes up on transactions all the time, which is the seller's warranty of their work. And typically, in my experience, somewhere between 6 to 12 months is the typical warranty on work. So if a patient presents for a recare issue in that whatever time frame has been agreed to, it's really the responsibility of the seller to make good on that dentistry. Sometimes that's easier to do when the seller stays. So if the seller is staying on for a year or two post-closing, they can fix things as they need to as they come in. It gets a little more complicated when they make a quick exit and then somebody shows up. Let's say they've moved away to Arizona or Florida and they're hitting golf balls somewhere and they're not coming back. You now have to perform the corrective treatment as the buyer, and you've got to deal with getting paid for that. So, some ways to avoid issues with corrective treatment are, the seller obviously staying on post-closing is helpful. Knowing the quality of the seller's dentistry as part of your due diligence is very helpful. Was the seller performing great dentistry? When you look at charts, do you not really see much in the way of anyone coming back? If you interview the staff, when you ask them the question, so how often, do patients come back with complaints or need recare on it or something to be redone? Does that happen once a week, once a month? Sniff it out in advance because you might learn a lot about the practitioner and the practice you're buying.
Now, would you, in the purchase, let's say you were doing an all-cash purchase, would you hold back 10% of the money just in case for a year or something like that, just to cover these possibilities?
Yeah, so I'll usually ask the parties, okay, what's the post-closing relationship look like? If they're staying on for a year or they're going to be at the practice for a while, I'm less concerned because they're going to be there, right, and we'll work it out. When it's a quick exit, so where it's been made very clear, hey, I'm giving you 60 days or 90 days and I'm out of here, in those scenarios, I do try to advocate for an escrow or a holdback, like you suggest, of some amount of money. The problem I find is that because that is so uncommon in dental deals, that there's a lot of pushback when you try to escrow, which is funny because in traditional mergers and acquisitions, escrow is standard to support your representations that you've made. And it's very typical that there might be as much as a 10% holdback of the purchase price. But in dentistry, it's so uncommon that when you suggest it, a lot of times you get a lot of pushback. But in situations where they're going to be gone relatively quick, I like to push for an escrow. Where there's a promissory note, just as a side note, you can put in what we call set-off language and say, okay, well, if this happens, I'm going to set off the amount I'm owed from the promissory note. So again, when there's paper being held, sometimes you feel good about that as a buyer because the seller has an interest in behaving until they get paid. So,
right. If he's carrying, 100,000 of the purchase price, you can write it so that, look, there's been $10,000 of work that needed to be redone here that I've had to do. So I owe you 90. So, right. It's perfect. So,
yep. All right. So now we're down to our last substantive slide here, which is just talking about transition periods, which I alluded to a little, as part of some of the other slides. But people will often ask, okay, so what should the transition period be? How long should the seller stick around? And the answer is, of course, it depends. with DSO transactions, or when multi-practice operators are buying a practice, it's very common that the employment period is longer post-closing. You know, DSOs typically would really like to see 2 to 5 year employment agreements. 3 years is kind of a sweet spot for a lot of the DSOs, but I see contracts mostly in the 2 to 5 year range for their continued full-time employment post-closing. And multi-practice operators are similar because, not unlike a DSO, you know, they don't want to be actually, you know, turning a handpiece in all the practices they own. So they're counting often on the seller sticking around for a while and continuing to perform dentistry because they own several practices. In earnout scenarios, typically you're going to want the seller to be around for the length of the earnout, and the seller should want to be around for the length of the earnout, because the way they ensure that they're going to get their percentage and that it's going to be, you know, live up to their expectations in terms of what they end up with a purchase price, is by having more control over their destiny by continuing to practice throughout the period of the earnout. And then in traditional practice purchases, whether it be you know, general dentistry or specialty, it depends. So for example, if I have a fee-for-service practice or I'm a specialist, that's going to be a longer transition relationship, because I'm not just transitioning patients, I'm transitioning referral sources, right? If I'm a specialist, I'm literally going to be transitioning the relationship of a referral source. That's going to take a longer period of time. And if I'm like a high-end fee-for-service only practitioner, you know, my patients can go anywhere they want and pay. You know, they're already paying any amount, you know, that's being requested. They're not only going where insurance is taken. So, you know, I think that there's some relationship building that's a little bit different there. And, you know, on the flip side, in an insurance-driven practice, you know, often lengthy transitions are not really required. I think most practitioners feel that if you are a qualified dentist, you receive a strong recommendation from the prior owner, and you know that you are introduced by the prior owner and there for you know, a treatment cycle, that's an adequate transition in an insurance-based practice, because usually that patient is going to give you one bite at the apple to, you know, right now, you know, they know the staff. The staff is the same staff they had before. It's the same location they've been going to. All their records are there. They've, you know, a strong recommendation has come in by the prior owner. And if you're qualified, you're going to have an opportunity most likely to treat that patient and retain them. So not necessary to have as long of a transition as you would in some of the other scenarios. And that is really, that's really it. You know, it was very, very fun to do this with you, Fred. I had a good time and enjoyed it. And as you know, we've talked about it. We're going to be coming out with a book that's going to really dive into a lot of our stories. That, you know, this was a technical lecture that kind of went into a lot of the nuts and bolts. But we've kind of spent some time putting a fun book together, compiling 21 years of stories on making deals in dentistry, and we're going to be launching that in Vegas in October, which we're pretty stoked about.
That's fantastic. Well, this has been obviously incredibly valuable information, and navigation is the right word, because, you know, there's a bunch of whirlpools and straits that they could find themselves in if they don't see what's coming ahead of time. And I think this helps them to both manage their expectations and protect them. So thank you very much, Bill, and thank you, Fortune Management, for bringing Bill in and creating this format so that people can learn this incredibly valuable information. And I look forward to seeing you out on the lecture circuit, Bill.
Absolutely. Thanks again, and thanks for having me.